If you're a private lender, a hard money lender, or any type of lender, you need to follow these 4 C's to make sure you are protecting your investment and you're underwriting loans properly. Number 1, collateral, the most important thing. 95% of our underwriting is based on the collateral. Is it a good property in a good location and a piece of real estate that if we had to foreclose on to protect our investment, that we'd be willing to own and take back and potentially sell off to another real estate investor or maybe even keep for ourselves? You know the term location in real estate? Well, for lenders, it's collateral. We're doing first lien positions on investment real estate or commercial properties, and the underlying asset is the collateral. If the borrower walks away from the project, something, God forbid, happens to them, is this a piece of real estate that is worth it? You need to understand how to underwrite collateral, how to pull comps. You can't necessarily rely on real estate agents or other investors or appraisers. They don't have an economic interest in the property. You do. You make the underlying decision if it's a piece of real estate, if it's a piece of collateral that you want to lend on. Number 2, character. By far the second most important C of them all. Do the borrower have good characteristics? Are they good at communicating? Do you believe that they can execute on project? Are they a good person in general? A good project will get messed up by a bad borrower all the time. You can have the best collateral in the world and you put a bad operator or a bad character in place, and that project will fall apart and potentially default. You might not lose money on the deal, but the deal will be a headache. If you have a hard time communicating with the real estate investor borrower client right now, what's going to happen when they owe you money? You think they're going to return your call? If they want money from you now, it better be easy to communicate with, because when you need money from them in the future for monthly payments, repaying loans and things like that, and you can't get a hold of them, that's going to be a problem. Good borrowers typically make so-so and sometimes bad projects excel, and bad borrowers will bring down good projects all of the times. That's just what happens. If you're newer in this business, I would 100% recommend you go to every property and meet all of your borrowers. It's very, very important to do so. It goes a long way, not just for underwriting purposes, but creating relationships with these borrowers, because in essence, they turn into repeat borrowers in the future. Number 3, capacity. Does the borrower have the capacity to do this project? Not all good projects and not all good borrowers have the ability to perform and have the capacity to do so. Now, what do I mean by this? Well, capacity, do they have enough cash to do the deal? Do they have the wherewithal to execute on a project? If it's a first-time real estate investor, they probably shouldn't be doing new construction. They probably just won't have the ability to do so. Could they fumble their way through it? Possibly. But you want to match the right borrower with the right project. Now, if they have $20,000 to their name and that's all the money they have, you can't really do a project with them. They don't have enough money for down payments, to make monthly payments, to front the first construction draw, to cover any reserves. They just don't have the means to do that. They're going to need more cash to do that, meaning they don't have the capacity to do that. They might have experience, they might have good credit, they might have found a good project, but they might not have the capacity to execute on this particular deal at this particular time. So it's something to think about. Number 4, credit. Do they have good credit or do they not have good credit? In our experience, real estate investors with bad credit have a hard time executing on construction projects. They can't manage their household bills. How are they going to manage a construction project? Every large construction project matched with a real estate investor with lower credit has defaulted. That doesn't mean you lose money as a lender by them defaulting, but it's going to be a headache. You're going to have to figure out a way to engineer a plan for them to bring the loan into good standing and figure out a way to recoup your money. We're in this business to write good loans to good real estate investors that are going to perform, pay us back, and then we can recycle the funds over and over and over on the right real estate projects. That's what this whole private lending business is about. We're not loan-to-own lenders. Any good project that potentially you go into as like a loan-to-own, chances are you're never getting that project back anyways. Credit isn't everything, but it certainly tells a story. I've seen lots of borrowers with 700 credit scores that have lousy credit on paper, and for some reason their score is still 700. I've also seen borrowers that have low 600 credit scores that for the most part just might have higher leverage, or they have high mortgage balances and they've never really paid late, and they're figuring out ways to pay their bills, and in essence their credit isn't all that bad. They just have a lower score. So make sure you're pulling credit, all 3 major credit bureaus. That's important. Pull credit through a reputable source. Make sure you're reviewing it, analyzing it, not just going off the score, and matching the credit to the project. Let's sum all these up because these all work hand in hand and they're all very, very important. Collateral, number 1. Is it a good project? Is it a good piece? Is it a good house or real estate project? Number 2, character. Do they have good characteristics and do you think they're going to be an honest, reputable person that's going to execute and pay you back? Number 3, capacity. Do they have ability to do this particular project? Do they have enough cash? Things like that. And number 4, credit. All of these go hand in hand, and all of these are very important. As private lenders, as hard money lenders, or any type of lender in general, you need to wear your underwriter hat. Yes, I understand that in essence, you need to go out there and you have to find projects and work with real estate investors, but you need to wear your underwriting hat. You can't lose investor capital. You can't lose your own money. It doesn't work like that. You have to write good, safe loans across the board, and you got to follow these 4 C's because they're a proven model. Inside our business, we stick to the 4 C's and we follow them religiously, and I'd encourage you to as well. Any questions related to this topic or any other topic, private lending or hard money lender, just comment below. I'm happy to personally answer all of those questions. Comment below. If you enjoyed this video, certainly appreciate it. You smash that like button, and if you really like this video, smash that subscribe button so you can share this with other friends, private lenders, real estate colleagues. Until next time, I'm Jason at Hard Money Bankers and Hard Money Mastermind. Take care.